Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Once again, happy Friday. Hope you guys are doing fantastic. Well, we saw interest rates finish the week slightly worse than where they ended that last week. Wasn't a big movement, and rates are so phenomenal that it's not a dramatic change. But rates did get slightly worse. Now, we saw a lot of economic data released into the market in terms of things that would have an impact. With the jobs number as well as some inflation data, which I'll get to in a second, but there was also some other data that was pretty important as it pertains to housing and what's going on in the overall economy, or global economy. So first of all, we did see CoreLogic release their index, and it showed that national appreciation rates over the previous 12 months actually were increasing at a rate of about 5.7%, and they said that they expected national rates of appreciation to increase at about 5.3%. So very, very healthy levels. The rate of appreciation might be slowing a little bit, or at least that's predicted to, but it's very slight and real good, strong housing numbers. Not too hot, and definitely, obviously, not too cool because it is increasing. We also did see that the Bank of England actually announced that they would be reducing what's their equivalent of the Fed funds discount rate by 0.25%. So they're trying to stimulate the economy, obviously over this whole Brexit thing. But what that has done, and they also announced that they were doing some similar economic stimulus like what we had done in the past with quantitative easing, that they were buying their equivalent to bonds. So what that is caused the dollar to strengthen, which causes, and our yields in the United States to look better. So that causes money to flow globally into the United States and help, generally speaking, support mortgage-backed securities and even help the stock market. We also saw some of the inflation data that the Federal Reserve loves to follow most, with the PCE, the personal consumptions, expenditures, Fed's favorite gauge of inflation, and it did show that inflation was relatively tame. It did show an increase of 0.9%, but if you strip out the volatile food and energy, the index only increased 0.1% on the month-over-month level, and year-over-year, it's only at 1.6%. So that is lower than the Federal Reserve's target of 2%. Now, the big number that everybody was watching was the jobs number. That was, once again, a shock to more jobs being added to the market. Expectations were for about 165,000 jobs being added, and it actually came in at 255,000. The unemployment rate stayed at 4.9%. And there was about a revision of 18,000 jobs added to the previous number, and that was already a strong number. Typically, that would have caused the stock market to rally, and actually mortgage-backed securities to really suffer because of this big surprise. Just like last month when there was a big surprise, though, the bond market didn't do too badly, and mortgage-backed securities didn't do too badly. Same thing today. So even though it was a much stronger jobs number, the market, while it's getting a little bit worse, it was not disastrous. And here's why. These jobs that are being added are not fantastic jobs. The U6 number, which actually includes people who are unemployed, those that are marginally attached to the workforce, and those that are working part-time for economic reasons, meaning that's the only job that they can get, that number is actually pretty high. That number is actually at 9.7%. So even though we have the unemployment rate at 4.9%, we have close to 10% of people who just don't have the type of jobs that they want. And a year ago, that number wasn't that much worse than that. So it was actually about 10.4% in July of 2015. The labor force participation rate, which measures how many people who could be working, are they really working? Well, that was at 62.8%. And that's one of the lowest or worst levels, I guess, since the 1970s. Not the absolute worst. It was at 62.6 in July, so things are getting a little bit better. But back in 2015, this was at about 62.6. So really not that much of a change there. So with the numbers, with the jobs report, it did cause the benchmark or the gauging of will the Federal Reserve actually increase credit next meeting to go from 18 to about 22%. So still not a lot of people think the Federal Reserve will actually increase rates. And sometime this year, it went from about 32 to 40%. So still, these jobs numbers did provide maybe some thought that the Federal Reserve might do something, but it didn't dramatically change things a lot. So anyway, that's what's going on with interest rates. If you have any questions, please give us a call. If you're working this weekend, so are we. So thanks for joining me with Java with Jared, and we will talk to you soon. Bye-bye.